All right, welcome back to the deep dive. I want you to picture something for me. You're driving down, one of those big commercial strips you find in pretty much any town in America.
Mhm.
You go past the fast food places, the auto parts store, and then you see it. It always has this big, bright sign in the window.
Yeah, you can't miss it.
Exactly. Maybe it says no credit needed, or like 19.99 a week. And when you look inside, you see these rows of, I don't know, 75-inch 4K TVs, huge leather sectionals, gaming laptops.
The whole 9 yards.
We are talking, of course, about the world of rent-to-own.
It's a landscape that is, I think, simultaneously incredibly familiar to everyone and at the same time almost completely misunderstood.
Yes, it's part of the background radiation of the American retail experience.
It really is.
And I'll be totally honest, when I first started looking at the research for this, I had a very specific idea in my head. I thought, okay, this will be simple. We're going to talk about washing machines, high interest rates, and, maybe some predatory practices.
A pretty straightforward story.
That's what I thought. But as I started digging into these notes, we've got court cases, academic papers, FTC reports, I realized how wrong I was about the scope of this. This is not just about sofas. It is a massive, incredibly complex legal and financial ecosystem.
It is. It starts with washing machines, sure, but it spans all the way to high-stakes real estate deals.
And it gets even weirder from there.
Oh, yeah. If you follow the thread all the way to the end, you find yourselves talking about things like digital gold and theoretical inflation-proof savings accounts. It is a genuine rabbit hole.
So that's our mission for this deep dive. We are going to map out that entire ecosystem. We need to figure out the mechanics of it. Like, how does this actually work?
Why does it even exist in the first place?
And why is it so controversial? And this, I think, is the most important part. How is it legally different from me just, slapping that TV on my Visa card? Because that legal distinction is the linchpin. It's everything.
It is absolutely everything. And to get there, we have to start with the definition. Because rent-to-own is a great marketing term, but it is also a very specific legal construct.
Okay, so let's clear the fog right away. When I walk into that store and I sign the paper, what am I actually agreeing to?
At its most basic level, rent-to-own, and you'll hear other names like rental purchase or rent-to-buy, is a legally documented transaction for tangible property.
Tangible property. So stuff you can touch.
Exactly. Furniture, electronics, appliances, even cars. And then in the housing market, of course, the home itself. The lessee, that's you, the customer. You agree to make a payment, usually weekly or monthly, to use that item.
Okay, so far that just sounds like renting.
It does, but here's the defining feature, the thing that makes it rent-to-own, and not just rent, it's the option to purchase.
Right, so there is a light at the end of the tunnel. I'm renting, but someday maybe I can actually own this thing. But this is where I get a little stuck. How is that different from, say, a traditional lease or something like a hire purchase plan?
This is the crucial distinction. This is the legal ground the entire industry is built on, and it's almost like a magic trick. There are two really big differences.
Okay.
First, unlike a traditional lease, think about leasing a car for 3 years in a rent-to-own agreement. You, the lessee, have the specific right to purchase the item during the agreement. You don't always have to wait until the end.
Okay, so there's an early out option. That's nice, but I'm guessing the second distinction is the really big one.
It's the game changer. This is what separates RTO from what they call hire purchase or any kind of installment plan.
Yeah.
In a rent-to-own agreement, the lessee can terminate the entire agreement by simply returning the property.
At any time.
At any time, with no further obligation.
Okay, let's stop right there and really unpack that, because I think for a lot of people, this is the aha moment. Let's do a comparison. If I walk into a big box electronics store and I buy a $1,000 TV on their store credit card, what have I actually done?
You have purchased that TV. The second you sign, you own the TV, but you also own the debt. You've signed what's called a promissory note. You're saying, I promise to pay $1,000 plus interest. If you stop paying 3 weeks later, you have defaulted on a loan. It's a breach of contract. They can sue you. They will absolutely ding your credit score. They can send debt collectors after you for the full balance.
Right. I'm on the hook for the entire grand the minute I sign that paper.
Correct. Now, let's look at the rent-to-own contract for that same TV. In that scenario, you are not buying the TV.
I'm not.
No, you are renting it for 1 week. That is the entirety of your legal commitment, 1 week.
So when I sign the contract, I don't owe them $1,000.
Nope. You owe them, let's say, $20, the price of 1 week's rent. At the end of that week, you have what the law calls a unilateral option.
Unilateral meaning it's all my choice.
It's all your choice. You can choose to renew the agreement for another week by paying another $20, or you can hand the TV back to the store and walk away.
And if I walk away,
Yeah.
what happens?
Absolutely nothing. You owe nothing. There's no remaining balance. There's no default on your credit report. Because you have the right to terminate at will, the law, at least in most states, says you technically do not have any debt.
Wow, that is incredibly slippery. It's like Schrodinger's debt.
Schrodinger's debt is actually a perfect way to describe it.
It exists if I keep the TV, but the second I return it, poof, it vanishes from reality.
Exactly. And that terminable at will clause is the legal shield. It protects the entire industry from being classified as a lender. If you can terminate at will, it's not a loan. And if it's not a loan, you don't have to follow federal lending laws.
And there's no interest rate cap.
There is no interest rate cap.
Which explains how you can end up paying 3 times the retail price.
Hmm.
But we'll get to the math of that in a little bit. I want to understand where this whole idea came from. Because looking at our notes, I really did assume this was an American invention. It just feels so American, you know?
Yeah, consumerism, instant gratification.
Totally. But that's not the real origin story.
Not entirely. I mean, the U.S. market absolutely perfected the scale and the branding of it. But the core concept actually has these deep roots across the pond.
Okay.
The use of these kinds of transactions really began in the United Kingdom and in Europe under a model they called hire purchase.
And we have a really specific and I think cool example of this, a company called Lotus Radio.
Yes, Lotus Radio in the UK. They were established in 1933.
1933. So we are deep in the Great Depression. This isn't about getting a new toy. This is something else.
The context is everything here.
Yeah.
In 1933, a radio wasn't just a gadget. It was your internet, your TV, and your newspaper, all rolled into one device. For many people, it was the only connection to the outside world.
But they were brand new tech, so they had to be incredibly expensive.
Hugely expensive. Very few working-class families in Depression-era Britain could just, slap down the cash to buy one outright. It was impossible.
So Lotus Radio stepped into that gap.
They step in. They operated as a radio rental business. You couldn't afford to buy, but you could afford to rent it for a few shillings a week. You get the news, you get the entertainment, you get the status of having a radio in your parlor.
But you don't need the capital up front.
Exactly. It's almost like the Netflix subscription of its day, but for the actual hardware. It solves a problem of access.
And that fundamental dynamic, providing access without requiring capital, that's the DNA of the industry, isn't it? It's the same principle today.
It is exactly the same. But that idea did eventually make its way over the Atlantic.
Right. It lands in post-war America. We're talking the 1950s and 60s, this huge economic boom. And our notes point to a couple of founding fathers of the American industry.
Yeah, it's a classic American entrepreneurial story, really. First, you have a guy named Charles Loudermilk Sr.
Okay.
In 1955, he started a business, and what he did was he rented out Army surplus chairs.
Army surplus chairs. You can't get a more humble beginning than that.
I mean, it's as grassroots as it gets. He was renting them out for events, weddings, parties, that kind of thing. But he must have realized the power of the rental model itself. That little chair business eventually evolved into Aaron Rents.
Aaron Rents. Okay, now that's a name that pretty much everyone in the U.S. has seen on a strip mall somewhere. They're a giant.
One of the two giants.
So who's the other titan?
A man named J. Ernest Talley. He started a shop in 1963 in Wichita, Kansas called Mr. T's Rental.
Mr. T's Rental. I love that name. It's fantastic.
It is. And he later helped establish the other big name in the industry, Rent-A-Center.
So between Loudermilk and Talley, starting with chairs and some basic appliances in the mid-century, you basically have the seeds of the two biggest heavyweights in the entire American market.
You do. They built the whole thing.
And heavyweight is definitely the right word. I was looking at the stats for their trade association, APRO. This isn't some niche little corner of the retail market anymore.
No, it's a behemoth. So APRO, that's the Association of Progressive Rental Organizations, they formed back in 1980.
Okay.
At the time, they had about 40 member companies. And they really formed because the industry was getting a bit of a Wild West reputation. They needed to standardize their practices and, let's be honest, polish their public image.
So how big are they today?
Today, APRO represents about 350 member companies. And those companies operate roughly 10,400 stores.
10,000 stores.
Across all 50 states, plus they've expanded into Mexico and Canada. But here's the number that really blew my mind. At any given time during the year, They're actively serving about 4.8 million customers.
4.8 million people. That's larger than the population of Los Angeles. That is a significant chunk of the economy that is actively using this model to get goods.
A huge chunk. And it's not just a North American thing anymore. It's growing globally.
Yeah.
The source material we have specifically calls out South Africa as this new booming market for RTO.
Why South Africa? What's special there?
It's sort of the perfect storm for this business model.
Yeah.
You have a rapidly growing middle class that has the desire for consumer goods. They want the tech, the appliances, the nice furniture. But you also have a financial system where a lot of those same people don't have an established credit history, or they don't have deep savings. So there's a gap.
The same gap Lotus Radio was filling in 1933.
Exactly the same gap. And it's working. The projected revenue for RTO in South Africa is expected to hit over $357 million by 2025.
Wow. So the model travels really well.
Right.
Wherever you find that gap between consumer desire and access to traditional capital, RTO can slot right in.
It slots right in and fills the vacuum.
Okay. So we've got the history, we know the scale. Now I want to get back into the weeds of the transaction itself. Let's return to that sofa scenario. I walk into the store, I see the sofa I want, I sign the paper. How does the money actually work week by week?
Okay, let's break it down. You sign an agreement for a rental term. It's usually weekly or monthly. You pay your first week's rent, let's call it $30. You take the sofa home. Now, at the end of that first week, you are at a decision point.
This is the option part of rent to own.
This is the option. You have choice A, you renew, you pay another $30, you get to keep the sofa for another week. The contract continues.
And choice B.
Choice B, you terminate. You call them up, they come get the sofa, or you bring it back and the deal is done. You're out.
But most people go in wanting to own the thing, right? They don't just want to rent a sofa for a few weeks. What is the actual path to ownership?
There are generally two paths. The first one is just endurance. You just keep making those weekly payments for the full term laid out in the contract.
And how long is that usually?
It varies, but typically it's something like 12, 18, maybe 24 months. If you make every single one of those weekly payments without missing one, at the end of that term, the store hands you the title. The sofa is yours, free and clear.
But if I do the math on that, $30 a week for, say, 18 months, that's a lot more than the sofa would cost at a regular furniture store.
It is. It's a lot more. And that's usually why there's a second path. Most of these agreements have what's called an early payoff option. This allows you to buy the item outright at any point during the rental period. And usually there's a formula for it, often a discount if you pay it off sooner rather than later. So maybe 3 months in, you get your tax refund and you say, you know what, I'm just going to pay off the rest and be done with it.
So there is some flexibility built in. And according to the FTC's survey data we have from back in 2000, that flexibility is a really big deal for the people who use this.
It is a huge deal. The Federal Trade Commission did a pretty deep dive into customer motivation. And the results were really interesting. I think there's this assumption that people use RTO because they're, financially illiterate or they're being tricked. But the survey suggests it's much more about necessity and a lack of other options.
So what was the number one driver for customers? Why did they choose this?
The number one reason, by a long shot, was the lack of a credit check.
Yes.
That's the key. If you have bad credit or maybe no credit history at all, you could be young, you could be a new immigrant, maybe you went through a bankruptcy, you simply cannot get a traditional loan. The door is closed.
So rent-to-own is literally the only door that's still open.
For many people, it is. The second big driver was just the ability to get merchandise they couldn't otherwise get.
Yeah.
Think about it. If your refrigerator dies tonight, wait 2 weeks. You need a refrigerator now.
And if you don't have $800 cash or a credit card with a high enough limit,
you're stuck. RTO solves that immediate emergency problem. And then people also cited things like convenience, the free delivery and setup, the speed of the whole process.
But the industry also has a defense for that high sticker price, right? They don't just say it costs more. They say you're getting more.
Yes. This is a very important part of their argument. They say that when you compare the total RTO price to the cash price at a retail store, you're not comparing apples to apples.
Why not?
Because the RTO price includes what they call a bundle of services.
Okay, what's in the bundle?
Well, delivery and assembly is one. But the really big one is service and repair. If you buy a washer from a big box store and it breaks in month 13, right after the manufacturer's warranty expires.
You're on your own. You're paying for a repairman or a new machine.
Right. But in an RTO agreement, because you are technically still renting the item until the very last payment, the store is usually responsible for fixing it. If your RTO washer breaks, You call them, and they have to come out and repair it or replace it, usually at no extra cost to you.
So it's like a service plan or an insurance policy is baked into that weekly fee.
That's the argument they make. They also point to the risk that they take on. Because you can return that sofa at any time, they're running the risk of getting back a used, slightly worn piece of furniture that they can't resell for full price.
So that depreciation risk gets priced in.
They argue that it has to.
However, we absolutely have to talk about the controversy because you don't get 47 states passing specific laws to regulate an industry if everything is sunshine and roses. And the cost is the main friction point, isn't it?
It's the lightning rod. It's what gets all the attention from consumer advocates, from attorneys general, from legal aid societies. They've all banged the drum on this for years.
And the numbers can be pretty shocking.
They can. When you do the math and you calculate what the effective interest rate would be if you treated it like a loan, it can be astronomical. We're talking 100%, 200%, sometimes even higher.
So you could end up paying $3,000 for a TV that you could have bought for $1,000.
Easily.
Yeah.
And the core criticism is that this model disproportionately targets the people who can least afford that premium.
It's what some people call the poverty premium.
Exactly. The idea that it costs more to be poor. If you had good credit or cash in the bank, you'd pay $1,000. Because you end up paying $3,000.
Did the customers in that FTC survey, did they feel ripped off? What was the sentiment?
It was a bit mixed. But high prices were by far the #1 complaint. People weren't naive. They knew they were paying more, and they didn't like it.
What else did they complain about?
There were also a lot of complaints about how employees treated them when payments were late. Aggressive collection tactics, constant phone calls, that sort of thing.
Mm-hmm. Speaking of collections, we have to talk about the repo man. There's this cultural myth, this horror story, that RTO stores will wait until you've made like 99% of your payments. You're 1 week away from owning it. And then if you're 1 day late, they snatch the TV back so they can rent it out to someone else and start the whole cycle over.
It's a pervasive story, and it's a terrifying one, right? The idea that you could invest all that money and build up all that equity only to lose it all right at the finish line.
So is it true? Does that really happen?
According to the FTC's own research, they found a low incidence of this actually happening.
Really? Why not? I mean, it seems like a profitable, if evil, thing to do. Are the stores just being nice?
Not necessarily. It's mostly because of state laws.
Yeah.
Most states have passed laws creating what are called reinstatement rights.
Reinstatement rights, how does that work?
It's a huge consumer protection. Most state laws say that if you default on your agreement and the store takes the item back, you have a certain window of time, maybe a week, maybe a month, to reinstate the contract.
So you can get it back.
Yes. If you come up with the money you owe within that window, the store is legally required to give you the item back, or a comparable one, and let you pick up the contract exactly where you left off. You don't lose all the progress you've made.
Wow, that's a massive protection. It basically neuters that whole predatory snatch and grab tactic.
It does. It forces them to preserve the equity that the consumer has already built up in the product.
Okay, so we've got the mechanics, the motivations, the pros, the cons, but this leads us directly into what you called the engine room of the whole industry, the legal battlefield. Because as we talked about with Schrodinger's debt, the definition of this transaction is literally everything.
It is. This is section 3 of our dive, and you're right. This is where the whole business model lives or dies. It all hangs on one single massive legal question. Is rent to own a lease, or is it a credit sale?
Let's define the stakes here. Why does that one question matter so much?
It matters because of a very powerful federal law called the Truth in Lending Act, or TILA. TILA says that if you lend money or sell something on credit, you are legally required to disclose certain things very clearly. Chief among them is the annual percentage rate, the APR.
The interest rate.
Right. And even more critically, many states have what are called usury laws, which put a cap on that rate. Maybe it's 25% or 30%. You legally cannot charge more than that on a loan.
Okay, I see where this is going. So if rent-to-own is legally defined as a credit sale, then they would have to start calculating and disclosing an APR. And since their effective rate is often well over 100%, they would instantly be breaking the law in almost every single state. The business model, as it currently exists, would become illegal overnight.
But if it's a lease?
Leases are regulated completely differently. They don't have APRs. They don't have interest rate caps. You can charge whatever the market will bear for a 1 week rental of your property.
So in this massive legal war, who's winning, lease or credit?
Well, the industry has fought tooth and nail for decades to cement the lease definition in law. And as of our 2011 source data, they have largely succeeded.
47 states, plus the District of Columbia, Guam, and Puerto Rico, have all passed specific statutes that explicitly define these transactions as leases, not credit sales.
So they successfully lobbied state governments to get the law written in their favor.
They did. They wanted legal certainty. They were tired of getting sued all the time by consumers and attorneys general. So they pushed for these laws that basically say, as long as you clearly disclose all the terms of the rental, this is a lease. End of story.
But you said 47 states, so there are a few holdouts.
There are holdouts. It's not unanimous. While the state Supreme Courts in places like Massachusetts and Arkansas have sided with the industry and said, yes, it's a lease, you have these really important outliers.
Like where?
The state courts in New Jersey and Minnesota have both ruled that, no, this is a fiction. When you look at the economic reality of the transaction, it is a disguised credit sale.
So if I live in New Jersey, the rules are completely different.
Completely. In New Jersey, RTO transactions are subject to the state's criminal usury laws. That drastically changes how these companies can operate there. A federal court in Wisconsin also came to a similar conclusion.
So it's a patchwork of state laws. But has the federal government ever tried to step in and say, enough of this, here's the national rule for everyone?
For the most part, no. Consumer lawyers have tried for years to get federal courts to stretch the Truth in Lending Act to cover RTO. But the courts have generally been reluctant. They always come back to that same point.
The terminate at will clause.
Exactly. They say, look, the consumer can walk away at any time without penalty. That means it's not credit. End of discussion.
But there was one huge moment, one instance where the federal government did try to drop the hammer. And this story is fascinating because it doesn't involve the FTC or Congress. It involves the Department of Defense.
This was a massive existential crisis for the industry. You have to understand the context. It's 2006. The wars in Iraq and Afghanistan are at their height, and the DoD was noticing a huge problem. Young soldiers, 19, 20 years old, getting their first regular paycheck, were getting absolutely buried in debt.
They were seen as easy targets.
They were prime targets. The areas around military bases were often magnets for payday lenders, title pawn shops, and, yes, rent-to-own stores. The DoD came to believe this was a military readiness issue.
Oh, so?
If a young soldier is stressed out about debt collectors calling his commanding officer, he's not focused on his mission, he's a security risk.
So what did the DoD do about it?
In 2006, they released a major report on predatory lending practices directed at members of the armed forces. And in that report, they explicitly labeled rent-to-own as a predatory lending practice. They lumped it right in there with payday loans and title loans. They called it an abusive credit transaction.
Whoa, wait a second. If the Department of Defense officially calls it a credit transaction, that blows up the industry's entire Schrodinger's debt argument.
It completely destroys it. If that definition had stuck, it could have been the domino that fell, forcing RTO under TILA regulations at the federal level. For everyone, it was a five-alarm fire for the industry.
So the industry must have gone into full panic mode.
Panic is an understatement. But they didn't just panic, they fought back. And what's so interesting is that the most effective pushback didn't just come from industry lobbyists. It came from another government agency, the Government Accountability Office, the GAO.
Government's auditors.
Right, the watchdogs. In 2007, the GAO took a look at the DoD's report and essentially said, wait a minute, show your work. They argued that the DoD hadn't provided enough evidence to prove that RTO was actually harming soldier readiness in the same way that high-interest loans were.
And they brought up a very specific counter-argument, didn't they? The deployment argument.
This was the winning argument. This is what turned the whole thing around. The GAO pointed out that the terminated at will feature of RTO was actually a significant benefit for military personnel. Think about it. You're a soldier. You live in an apartment off base. You go to an RTO store and get a sofa and a TV. Suddenly, you get deployment orders. You're shipping out to Iraq for a 12-month tour.
If you had bought that furniture on credit,
You're stuck. You're stuck paying a monthly bill for a sofa that's sitting in an empty apartment thousands of miles away. It's a debt anchor around your neck while you're in a combat zone.
but with rent-to-own.
You just call the store, they come pick up the sofa and the TV. You stop paying, you deploy completely debt-free. The GAO argued that this unique flexibility was incredibly valuable for a population that's subject to sudden, long-term relocations.
That is a fascinating pivot. They took the thing that critics hate, the lack of ownership, and turned it into a strategic advantage for a specific demographic.
It was brilliant, and it worked. Later in 2007, the Department of Defense completely reversed course. They issued their final rule, and in it, they concluded that rent-to-own was not a form of consumer credit and excluded it from their predatory lending regulations
The industry dodged a cannonball.
by the skin of its teeth.
Talk about a close call. It just goes to show how fragile and important these legal definitions are. One minute you're a predator, the next minute you're providing a valuable service.
It really does. And while that specific debate on the federal level kind of settled down, the RTO model didn't stop at sofas and TVs. We have to shift gears now, because this is where the stakes get much, much higher. We have to talk about rent-owned real estate.
This is where the numbers get a lot bigger and the potential heartbreak gets a lot more real. I mean, losing a TV is annoying. Losing your home and all the money you put into it, that's a tragedy.
It's a life-altering event. And the source material we have notes that these RTO housing options tend to surge during economic downturns. We saw a huge spike in these kinds of deals after the 2008 financial crisis,
Why then specifically?
because the banks slammed the door shut. After the subprime mortgage crash, getting a traditional home loan became incredibly difficult, especially for what they called subprime borrowers, people with imperfect credit scores.
But those people still needed a place to live, and many of them still had the dream of owning a home.
Exactly. So RTO steps into that vacuum as a kind of bridge. The pitch is, we'll get you into a house now, you can live in it like you own it, and then you can buy it from us later when your credit is fixed.
So the target audience is what they call the tenant buyer, someone who wants to buy but just can't get a bank loan today.
That's the ideal candidate. The whole goal is for them to live in the home while they actively work on fixing their credit or saving up a bigger down payment.
Okay, so how does the money work in these deals? I'm guessing it's more complicated than just paying your weekly TV rental fee.
It's much more complicated. The structure usually spans a period of 1 to 3 years. First, you almost always have to pay a significant non-refundable deposit up front. They often call it an option fee.
And we're not talking $20.
No, we're talking thousands, maybe tens of thousands of dollars.
And that money buys you the exclusive right to purchase the house later at a pre-agreed price.
Yes. It locks in the purchase price today. Then you start paying your monthly rent. But, and this is a critical detail, you typically pay a rent credit or a rent premium on top of the normal market rate.
Can you explain that? Give me an example.
Sure. Let's say the fair market rent for the house is $1,000 a month. The RTO contract might require you to pay $1,200 a month.
Okay. Where does that extra $200 go?
It goes into a virtual bucket, an
Yeah.
escrow account of sorts. The idea is that this is a form of forced savings, that extra money accumulates over the life of the contract to build up your down payment.
I see. So at the end of the 3-year term, you have the initial option fee you paid, plus all that accumulated rent credit money. And you use that whole pile of cash to secure a mortgage and finally buy the house.
That is the happy path.
Yeah.
That is how it's supposed to work.
Yeah.
But we have to talk about the trap.
The trap.
The trap is what happens if you get to the end of that 3-year term and you still cannot qualify for a mortgage.
And that could happen for any number of reasons, right? Maybe your credit score didn't go up as much as you hoped. Maybe you lost your job. Maybe the banks just tightened their lending standards again.
Exactly. Any of those things. If you can't get the loan from a bank, you cannot exercise your option to purchase. You have to walk away from the deal.
And what happens to all of the money you paid in? The big option fee, all those extra rent credit payments?
In most of these contracts, you forfeit everything.
Everything.
You lose the non-refundable option fee. You lose every single dollar of the extra rent credit you paid over those 3 years.
Ah, that is brutal. So you've essentially been paying above market rent for 3 years. Maybe you put your own money into fixing up the place because you thought it would be yours, and you walk away with absolutely nothing to show for it.
Zero. And the landlord keeps all that money. They keep the house, which you may have improved for them, and they can then turn around and offer the same deal to the next hopeful family. It can be devastating.
And because these contracts aren't standardized like a normal mortgage?
Exactly. The source material calls them flexible open source documents, which is a nice way of saying it's the Wild West. There's no standard form. This makes it a perfect environment for scammers who can write in clauses that make it almost impossible for the tenant to ever actually succeed.
Wow. It feels like such a high-risk gamble. But, and this is where the deep dive gets really kind of sci-fi, There are people out there trying to solve this very problem. We have some really new information in our source stack academic work from just last year, 2025, that proposes a way to fix the broken math of real estate rent to own.
This is the Nest Quest stuff. I have to admit, when I saw the phrase digital gold savings account in the research notes, I thought I was reading a crypto brochure.
Me too. I was like, where are we going with this? But this is serious economic theory, isn't it?
It is. It's a theoretical framework introduced by a researcher named Mohammed Billah. And the whole idea is to take the ambiguity and the all-or-nothing trap out of these agreements by using strict, transparent mathematical models. He calls them the Nest Quest ROI models.
Okay, let's try to break these down. There are 3 different models mentioned in the notes. The first one is called the RTO model, or the tripartite ledger. What on earth does that mean?
Tripartite just means 3 parts. Billah's argument is that the current system is too opaque. You just hand over this extra money to the landlord and you hope for the best. In his model, every single payment you make is mathematically and transparently split into 3 specific buckets: consumption, equity accrual, and operating costs.
Okay, consumption sounds like just plain old rent, the cost of using the house.
That's it. Operating costs would cover things like property taxes and maintenance, but the equity accrual bucket is the revolutionary part. Instead of just saving cash for down payment, the tenant in this model is actually buying fractional ownership shares of the property every single month.
So you're not just saving up dollars. You're literally buying, I don't know, 0.1% of the house this month, another 0.1% next month.
Exactly. You are building real, tangible equity from day one. And this is key. These shares that you own adjust with the market value of the home. If a house appreciates in value, your shares are worth more. It aligns everyone's incentives.
And crucially, it must protect you if you have to leave the agreement early.
That's the whole point. The model has defined pre-agreed rules for things like hardship pauses or exit settlements. If you have to walk away after 3 years, you don't forfeit everything. You own those shares. You should be able to cash them out or sell them to the next tenant. It turns the trap into a portable asset.
That sounds profoundly fair. But then we get to the second model, which sounds even crazier: the digital gold savings account. Why are we suddenly bringing gold into a real estate transaction?
One word: inflation. This is a huge hidden risk for today's RTO home buyers. You're saving up cash for 3, 4, 5 years to buy a house. But if inflation is running high, the purchasing power of that cash you're saving is rotting away.
You're running on a treadmill. The price of the house is going up because of inflation, and every dollar you save is worth a little bit less.
Precisely. You can't win. So Billah proposes a dual ledger accounting system. The system records your savings balances in 2 ways simultaneously: in your local currency, like US dollars, AND, in gold gram units.
Why gold?
Because gold has historically been a very effective hedge against inflation. The idea is to link the value of your savings to verified real-time gold price benchmarks. It's about preservation of value. It ensures that all the sweat equity you're putting in doesn't just evaporate into thin air before you get a chance to buy the house.
Okay, that makes a strange kind of sense. And the third model just combines the first 2, the RTO plus gold model.
Yes. This is the grand synthesis. It pairs the occupant's fractional equity accumulation with a systematic reinvestment process for the sponsor. That's the landlord or the property owner.
So what are they doing?
As the sponsor collects the cash flows from the tenant's payments, that money is automatically converted into gold index savings for them as well.
So the tenant is building home equity and the landlord is building a gold reserve.
Basically, yes. Everyone in the transaction is hedged against inflation. Billah highlights this as a framework for true risk sharing and auditability. It uses transparent math to try and ensure that neither side of the deal is exploiting the other.
It is absolutely amazing to see the arc of this story. We started with the family in 1933 renting a radio because they didn't have the cash to buy one. And now we are talking about mathematically formalized, gold-indexed, fractional home ownership models.
It's a wild evolution. But it's all an attempt to solve the exact same core problem. How do you get people access to major assets when they don't have a lump sum of capital up front?
So let's try to pull all of this together. We've gone from sofas to houses to economic theory. What is the big synthesized takeaway for you after going through all this material?
I think the synthesis is this. Rent to own, whether it's for a sofa or for a house, fills a vacuum. It exists because the traditional financial system, banks, credit cards, mortgages, excludes a huge portion of the population for various reasons.
It's a mechanism for access.
It is an access mechanism.
Yeah.
But, and this is the crucial but, that access comes at a premium. It always has. Whether it's the much higher total cost of a television or the immense risk of losing your entire deposit on a home, the consumer pays a price for that flexibility and for that lack of a credit check.
The industry would call that a fee for their service and their risk.
They do. And their critics would call it a poverty penalty.
And as we look to the future with these new theoretical NestQuest models, it seems like the goal is to try and bridge that gap, to keep the access, but to use math to lower the risk and the penalty, to maybe turn it into a legitimate pathway to wealth building instead of just a costly convenience.
Precisely. If we can solve the math problem, maybe we can finally solve the fairness problem.
You know, it really makes me think about where we're headed as a broader economy. We have subscriptions for our software, for our music, for our movies. We have rent to own for our furniture. We're now designing these complex rental access models for our housing. So here's my final provocative thought for you to chew on. Are we moving toward a world where ownership, in the traditional sense, buying something outright with cash and keeping it forever, is becoming a luxury service?
That is a profound question.
Is the future one where access is the standard model for the masses and true, unencumbered ownership is reserved for the wealthy few? And if these wild models like RTO plus Gold ever actually take off, could our monthly rent payments eventually stop being just an expense and start looking more like our investment portfolios?
Wow. I mean, if your rent payment is simultaneously buying you fractional equity in gold-indexed assets, the line between renter and investor gets very, very blurry. It could fundamentally change how we think about the concept of home.
It's definitely something to think about the next time you drive past that rental store with the neon sign. It's not just sofas in there. It's a window into a whole different way of interacting with the global economy.
Absolutely.
That's our time for this deep dive. Thanks so much for listening, and we'll catch you on the next one.